This is the video lecture on the closing process. Now, even though we've seen many different accounts up until this point, one thing that we haven't talked about are some of the account classifications. And one of the possible classifications has to do with the lifespan of the account. Some accounts that we maintain are actually going to be permanent accounts. And that means that these accounts will always remain open. They will remain open from the very first day that the business is formed all the way to the very end. And they will keep a running total that will always be in existence and will never be closed out. Most of the accounts that we deal with are going to be permanent accounts. But there are also some temporary accounts. And if an account is temporary, that means that they have to be periodically closed out. How often are they closed out? Basically, at the end of every accounting period. So, going with, say, a monthly accounting period, we would do these closing entries once a month to close out those accounts. Now, more accounts are permanent than temporary. So it's actually a lot easier, rather than trying to learn and memorize what accounts are permanent, it's easier to just learn what accounts are temporary because there are fewer of those. So the way this works is all the expenses, they're going to be temporary. All the revenues, income summary, and the withdrawal account. So those are our four categories of temporary accounts. Now when it comes to the revenues, every company is going to be different. Some companies only have one revenue. Then again, some companies have multiple revenues. But the idea is that any and all of them would have to be closed out. Same thing with expenses. Usually they're going to have multiple expenses. Same thing with withdrawals. But the one account that might look a little odd in this list is this one called income summary. And what's odd about that account is that is a brand new account that we've actually never talked about. And there's a good reason for that. This account only shows up during the closing process. And you're going to see something very interesting about that account when we actually close it out. Now, to go through this closing process, what we really need to do would be to complete the closing journal entries. And since there are four different types of temporary accounts, we're going to have four closing journal entries. So as long as you know what those four accounts are, it's easy to remember what the four entries are. And the idea behind this is these entries will close these accounts out, take them all the way down to a zero balance, and get them reset for a new accounting period. Now the information that we need, most of that information is going to come from the adjusted trial balance. And remember, we talked about that in an earlier video. Once I've done all those adjustments, I then have that adjusted trial balance. So what we have here is a sample trial balance, and this is after the adjustments have been prepared. And you can see that this company has a couple of assets, they have a liability, capital, withdrawals, one type of revenue, and a couple of expenses. So not a very detailed listing, but works pretty good for a basic example. And you can see, of course, that both columns do equal out, so we do have equal debits to equal credits on this trial balance. Now what I'm interested in, looking at this trial balance, I'm going to have to close out revenue. So I want to remember that. They do have one revenue account, rent revenue. It does have a $3,000 balance. Then I'm going to have to close out the expenses. There's two of those. And I'm also at some point going to have to close out the withdrawals. And what you'll notice is that some of these accounts have credit balances, some have debit balances. So in order to close an account out, I actually want to take it in the opposite direction of what the balance is. So something that has, say, a credit balance, if I would turn around and debit that account for that same amount, it would take everything out and take it down to zero. But the one thing that you don't see anywhere on this trial balance You don't see income summary. Remember we said that that was that odd account that only shows up in the closing process. So in order to close that one out, we're going to have to use a different technique. It's not going to be included on here. So the first closing entry is the entry to close out revenue. And like I said before, based on that company's trial balance, we said that they only had that one revenue account, and it was called rent revenue, and it was $3,000, and it had a credit balance. So notice that in order to close it out, I'm debiting rent revenue for $3,000, and then I have to credit income summary. So that's actually the very first time that the income summary account has been used. Then the second closing entry. In this entry, I need to close out the expenses. Well, the expenses all had debit balances. So in order to close them out, I would have to credit the expenses. So that's why you see both expenses that they had, salaries expense $1,500, utilities expense $250. Since both of those were listed and they both had debit balances, I'm going to credit those to wipe everything out all the way down to zero, and the total will be a debit to income summary. So that's the second time that I have used the income summary. Now, the third journal entry for closing is to actually close out the income summary. Now, what's odd about this is, how do I know the amount? Income summary was not listed on my trial balance. So what I have to do is I have to think about, when was the income summary used? Well, if we actually back up, we used it twice. Once we credited it for $300, then we debited it for $1,750. So that means right now it has a balance of $1,250. And that balance happens to be on the credit side. So that means I would have to debit income summary for $1,250 to get rid of that balance, and it gets closed out to capital with a credit of $1,250. Now what's interesting about that is the name of the account, income summary. It actually gets its name from the fact that this account actually summarizes the income statement. If you think about it, go back and look at when we used it. We used it here to close out revenue. Then we used it to close out all the expenses. Well, think about it. Revenue minus expense equals income. So that $1,250 is our revenue minus our expense. So income summary summarizes what is on the income statement. It shows the result of the revenue minus the expense. It's also worth pointing out that in this example, I debited income summary and credited capital, but it's actually possible in certain instances, if the company lost money, then this journal entry would actually be reversed. Because if they lost money, they would actually have a different type of balance, and I would have to actually debit capital and credit income summary. So this is one of those journal entries that you have to watch out for, because you never really know what it's going to be from situation to situation, depending on whether or not they made or lost money. So that's the third entry. And then the fourth and final closing entry is the entry to close out the withdrawal account. It had a $250 debit balance, so we will just credit that, and we'll debit that to capital to close it out, $250. So those are our four closing journal entries. Now, once we've completed the closing process, that's a good time to talk about the accounting cycle. The accounting cycle is actually the process that an accountant goes through every time they go through another accounting period. And the reason that we call it the accounting cycle is that this is a process that is never really complete. It begins and it ends, but then when you go into a new accounting period, it starts all over again. So whenever you see the word cycle, it brings to mind the image of a circle, and it is a never-ending circle. You finish one accounting period, you automatically transition to the next period. Now, once those closing entries have been posted, we will see yet another version of the trial balance, and this one will reflect all of the closing activities. So this version, again, just like the first two versions, shows that there are equal debits and credits. Now, if you look at the overall accounting cycle in terms of steps, you'll begin to realize that what we've really been doing with these last 2 or 3 assignments is we've actually been going through the accounting cycle. Because in the very first assignment that you worked on, you actually did the general journal entries. You had a series of transactions, and for every one of those transactions you did a journal entry, and then you posted those journal entries to the T accounts, and that enabled you to prepare a trial balance. And that was the final step on the very first assignment. Then on the second assignment, you prepared those adjusting journal entries. And once those adjusting journal entries were prepared, then of course you know that they are then copied over to the new version of the trial balance, which is called the adjusted trial balance. And once we have that version, the financial statements can be prepared from that. They can take literally all those amounts from the adjusted trial balance and put those right on the financial statements. Then we go into the closing entries. We just talked about those in this lecture, and eventually you're going to do those in an assignment. And then finally, post-closing trial balance. So those are the steps in the accounting cycle. It starts all the way back there with those very first journal entries that we recorded and continues all the way through to that post-closing trial balance. But even as you finish that post-closing trial balance, of course that's not the end of the story. That just simply means you have prepared everything to then begin a new accounting cycle. So it's a never-ending process that keeps repeating itself.